All right, so stocks ended the week on a kind of a little bit of a surprising down note. Again, the markets have been rebounding very nicely before Christmas and yesterday after the holiday, rebounding really nicely after last week's FOMC related drop. But it looked like we were in a kind of a nice, steady, slow volume, slow range, which is why we don't typically do these videos where we don't have our classes, market scholars, during the holidays, right? Not until after the new year. But I always mention if I'm around and if the markets are volatile, then I'll do a video that day, and that's what happened today. The markets had a pretty decent volatility day, especially right at the open. The VIX was up quite a bit. The markets were dropping. The markets ended up down, but off of their lows, and that had an impact on some of the patterns that I was seeing early this morning. That kind of led me to want to do today's video to kind of give you an update on what's going on. So we ended up avoiding some of the really bearish patterns that were cropping up. Excuse me, but it does put us into a little bit of a kind of like what we might see next week, considering the type of day we had and whether or not we can fill in the low end of today's range Monday and Tuesday next week before we head into the New Year holiday. So I'm going to break down kind of what's happening and why things dropped again today, and what's really kind of the big factor for the weakness that we've seen really over the past few weeks, despite the despite the little bit of a bounce. So we'll break all that down. The breadth today was abysmal. We'll look at that, and then we'll take a look at a trade in the technology sector that we want to do so well that has not been outside of the big names. So we'll talk about how to trade a stock in that space for our trade idea of the day. So let's go ahead and get started. Today is Friday, December 27th, 2024. This is the Market Outlook from MarketScholars.com. My name is David Settle. Before we get going too far, I invite you to subscribe to our YouTube channel. This icon here, the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos. And join our Market Outlook Facebook group that we've created. All right, if you're following us on our blog, check out some of these other things over here on the right, including our Market Outlook live video. This is where I take a look at old Market Outlook trades, see whether we should stay in them or get out of them. We also tend to put on that day's Market Outlook trade before the Market Outlook video gets posted, before the market closes. Come down to the bottom, click this heart. It opens up this tab. Hit that like button there. Click this thumbs up icon. It opens up this tab. Hit that like button there as well. Here, again, the more you do that, it helps get our content out to all of our followers on these platforms. So thank you to those who do that day in, day out. Those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. You can see the S&P after rallying for most of this past week, going into the weekend or like options expiration, then coming out of options expiration, doing a pretty good job. Today was a little bit more of a, that's why I'm doing a video today, it's a little bit more of a volatile day. Bigger range than normal, which is very rare for a holiday, for a day between the holidays, and finishing back below the moving average. So not a good finish. We could have had a much better finish. We could have 5 days in a row and potentially close to new highs, but we really dropped considerably here. Fortunately, we came off the low, so that helped keep our short-term sentiment from really being bearish. The momentum line was pretty low at the lows of the day, and the near-term line had crossed below the intermediate line. As of right now, as of the close, the near-term line stayed up above the intermediate line, which is rising in the upper half of the chart. That's why we have dark green shading, and almost back into bullish territory above the 60th percentile. But remember, any crossover between the reversal zones is either bullish, like it was here a few days ago, early in the week, or would be bearish if we were to cross back down. So we haven't crossed below 60 yet. We need to watch to see that first day we crossed below 60, where the momentum line is. And that was going to be today with a really bearish momentum line, but we avoided what could have been the worst case scenario just simply from this patterns perspective, and really only in the short term, right? the short-term sentiment. We avoided what could have been a pretty bearish pattern there. Market sentiments, where the intermediate line still below the market sentiment, so we're not out of the woods yet. Remember you can get the intermediate line below market sentiment during an intermediate run that usually produces the bull tags, but then you can pop right back up and get going again. And we did that. In fact, we fell again and then got going. So as of right now, we're not back up above it, and short-term sentiment looked to be pretty strong early this week, before Christmas, before already popping out of the reversal zone. And we'll see if on Monday, if we pop back out of bullish territory, and what that day ends up looking like on Monday. Your NASDAQ 100 was down 1 1/3% today. It did get that bearish crossover of the near-term line below the intermediate, though did not drop below 60 yet, because again we closed off of the lows of the day here. When you look at your Dow Jones Industrial Average, its intermediate line still in bearish territory, even with the rally we've had, and we're still well below the moving average, more than 2% below the moving average. Your near-term line still in bullish territory, so we're not doing too badly. It wasn't too bad of a down day on the Dow. The Russell was a little bit more, had the worst day, but still looks very similar to the Dow. We do have light green shading because the intermediate line crossed up above the upper reversal zone. So we do have that. That's working in our favor. But it's been barely out of the reversal zone. And again, the near-term line, it stayed, because of move off the lows of the day, the near-term line stayed in bullish territory. So we still don't have that first day crossing below 60, which, assuming we don't get a big bullish day Monday, because usually these days are very minimal. That's why I don't do videos normally on these days. But if we don't, that near-term line is going to cross below 60 on Monday, and then we need to see what kind of day that ends up being. All right, so as a result of that, if you take a look at the crossover chart here, the weekly crossover, you can see we ended up with a transition candle. So we've had multiple weeks now of transition. That first one was a relatively bearish candle. The second one was not. So these are true transition candles that don't necessarily mean that we're reversing. We're still above the moving average. We still don't have the red arrow. It is a red candle, so the green line is below 0 and still below its moving average, and the PPO is still falling. Of course, your Russell 2000 did get the red arrow, the transition, the bearish candle, a lower close. We didn't get a lower low, but we got a lower Heikin-Ashi close. And these are pretty decently sized candles with a falling PPO. If you take a look at the 3 green arrow chart, you'll see that, again, we don't have 3 red arrows anywhere except for the Russell 2000. The MACD is still negative. Stochastics is still below the 20th percentile. Everything else, you're kind of in this, we don't have any shading right now. We have 2 reds on the S&P. We have only 1 red on the Qs, and then we have the 2 reds on the diamonds with the 1 green down here. So we're not bullish, but we're not strongly bearish either, except, like I said, on the Russell 2000 right now. Looking at the 2-line version of this chart, you can see the S&P closing back below after being above the 17-day for 2 days. We closed back below the 17 and the 8-day, and at one point in time we had crossed back below the and the 30 for that matter. At one point in time we had crossed back below the 50-day with the MACD still below 0, still below its moving average and dropping back down, and your stochastics above its moving average but not back in bullish territory itself. You can see the above average volume that we had here today. All right, now let's take a look at the Russell 2000s, and you can see again it's well below its 50-day moving average, and still it never did get above the 17 or less. In fact, the last few days it did such a good job just to get to the 8-day before bouncing back down today. The MACD is clearly bearish down here at pretty low levels. Again, for some context and how low that is, relatively speaking, in the last couple of years. Again, it's about as bearish as we were at the very bottom in 2023, and then during the banking crisis, the momentum got about this low. So you notice it doesn't stay too bearish after. Like once you get, momentum this bearish, it's hard to stay down. It typically bounces, as we've seen already. Now let's take a look at some of these other oscillators, like the DMI, which had gone bearish and was improving, gotten back below 30 yesterday, bouncing back up above 30 today with a negative positive indicator, still below 20, in fact getting lower. So your ADX is rising up above 25, so you got the dark pink shading. And then you look at the RSI and the CCI. The RSI had crossed above 50. It did not cross above 60, so now that means that we're still red on this chart going through the end of this week. Right, remember it stops being red when it crosses 50, but only if that move gets above 60 and ends it, right? Okay, you can kind of see other instances where you cross above 50, but it doesn't get above 60, so you stay red. Same thing here when it crosses below 50. If it doesn't get below 40, it stays green. So that's kind of how we are right now, forming relatively bearish, potentially, right? It's only a one down day, but forming relatively bearish kind of near-term peaks here. Looking at the Ichimoku cloud, we still have a bullish trend. Like we ended the bullish trend, but we bounced back so hard that we were already back up to an intermediate strength bullish trend, just like that. Right? Isn't that crazy how it improved and recovered so quickly from hitting zero? And we're still there. So even with the decline today, we were below the blue line briefly, but we're still barely above it. And the rate of change had gone positive. We have to get a really good move here to keep it from going positive. The cloud itself is still green, so everything's still fine there. Not the case for the Russell. The Russell's cloud has gone pink. We are below the cloud. We tried to get back into it yesterday. We're back below the cloud now. The rate of change never did turn positive, still very strongly negative. And in fact, we're bordering on a mature strength trend, bearish trend for the Russell 2000. So things are dramatically different there. In fact, if you look at the Dow Jones, it's even a little different. They were below the blue line. The rate of change is flirting with being positive, but still negative. You're in the cloud. The cloud's almost pink. And you, again, have an intermediate strength trend to the downside going on the Dow Jones Industrial Average. If we take a look at the Bollinger Bands and the Keltner channels, we had gotten into the upper half of the bandwidth, but failed. But we're not back in the lowest quartile, so we're still okay. The bands themselves are still outside of the Keltner channel, and we are still between. Like we had a couple of days below the lower Keltner channel, but that was it. Our momentum is negative. It's actually not very negative, so it could be worse. But so far, so good. And if you look at IWM here, its bandwidth is huge, right? After having this size of bandwidth on a bullish move before, now it's bearish, and we never did get in the upper half of the bandwidth. We're close to the lowest quartile, still out of it, and we were below that lower Keltner channel with some very bearish momentum, but we're back above it at least. We were below it briefly at the lows of the day, but we're back above it for now. So far, a decent recovery, but not nearly as good a recovery as we're seeing in the large cap index, which, not surprisingly, is what's really driving this bounce back, right? It's all been driven by the large caps. So you can see the bands themselves are actually moved inside the Keltner channel. So we have a red dot on the QQQ on the bandwidth. If you take a look at the intraday chart, you can see we've been spending a lot of time in the lower half. I think we ended up closing just barely above the midpoint of the chart, just barely. After whipsawing down to extreme lows, and then back up and strongly into bullish territory, but not in the reversal zone, and then now back down out of bullish territory, but still in the upper half of the chart. So this is what it looks like. Lower high and the lower low, we gap down. There's a common gap, which actually is a good sign. We filled in the common gap from Tuesday that we hadn't filled in yet. So this is a good sign because, again, a common gap you would expect to get filled in sooner rather than later. We closed below yesterday's low. We did get, this two touch here. We did not get a new low point, but that's something, kind of keep an eye on. If we can get below 70, that'd be really good for the S&P. IWM also did not get a new low, but it's a lot closer to its low. We did not close below yesterday's low. We did not get that gap. We actually filled in some of the gap already. So a little bit different scenario here, and clearly in bearish territory when you look at it in its range here. When you look at the Russell 2000, I mean, even the moving average now is in the lower half of the chart, working its way down to bearish territory. So things are clearly more bearish on the broader index, right? The Russell 2000, rather than just the S&P 500, which is essentially just the S&P 10 for that, or whatever number we want to pick, which is really dominating a large percentage of the S&P right now. If we take a look at today's volume and trading range, again, this is why I'm doing the video. Normally, normally these intra-holiday trading sessions are very light, very small range, but we actually had above average range today at 7 points, 7-point range, and the volume you can see was above average as well, 64.8 million. So that's actually not, you can see the 7-point range is keeping us above 1%. Which is not a good sign, and then the volume is still rising. Again, you look at the IWM, and you can kind of see similar too, like we're still pretty high, but the key is that they're both rising. And then you look at like the volatility index. We jumped up today. We didn't get up above 20, but we jumped up quite a bit. I think we were up like 25% at one point early this morning. We did eventually drop all the way back down below 90%. But the VVIX didn't. The VVIX stayed and almost closed above 100. So a big bounce back on the VVIX. And then the skew has also been pretty scary. So yesterday it closed at 180. That's the highest level by far on record. This was the highest level on record in 2021 at 170, 170 and a half. Well, we've been killing that here. In fact, the 20-day average is almost to 170 and a half. Remember, 150, anything above 150 is extreme. So not surprising that we had a bunch of extreme readings back in 2021 because inflation was rising. Remember, we had 0% interest rates. Inflation was rising quite a bit. A lot of people were trading options, right? So options trading was very heavily in demand. Well, now you can see that's the case again. There's a lot of chatter about how much options trading has been going on here at the end of the year. And you can see, like I said, the skew ended up being today 173. So that's still a very high number and still above the average. So I'm going to venture to guess when this gets updated on Monday that the 20-day average is going to be close to 170, if not already above 170. That's a huge number because eventually this has got to come down, right? It doesn't stay high. The skew eventually comes down because there shouldn't be a lot of demand for deep out of the money puts, which is what this is measuring. This is saying at these extremely high levels, it's saying that there's an extremely inordinate amount of demand for deep out of the money puts right now. That shouldn't be the case in a normal, good bullish market. We should, in fact, every time we drop, it's actually, we bounce back up, you get back above the moving average. That's the good sign, right? Because, as you do experience decline, then there isn't a lot of demand now for deep out of the money puts because people are buying puts closer to being at the money during the decline. So it will drop, and then when you bounce back up above the average, you can see that's when the index itself bounces back up and gets going again. Well, you've got to drop first, and the problem with the skew dropping is that typically happens during a decline. Again, we saw that in 2021 at these high levels. And we're even higher now by a pretty large degree than we were then. In fact, if I change this to the 50-day to kind of give it a little bit broader time frame, we're almost to 160. We're well above 150, and we got above 150 over here for a brief period of time. We're going to be above 150 for a lot longer time now than we were in 2021. And we saw what that demand. The reason for that demand in 2022, which makes me wonder what the market has and what people are anticipating for the market in 2025 with such pent up demand here for put protection for not just any normal intermediate pullback, but 2 standard deviation drops. is what this demand is representing. All right, now let's talk about what's driving this price action today. What were some of the bigger moves on an asset class basis to finish up the last day of the week of what should have probably been just a really nice quiet up day. And you can see it was U.S. equities really got hammered. Whether it was small cap stocks or mega cap names, everything dropped down. But what's interesting is bonds dropped too. And so it's like this combination of higher yields and higher commodity prices, higher gold relative to everything else, really put pressure. In fact, if you look at the yields here, let me bring up the yields, and there's the crude oil up about 1% today. And commodity are, they changed from the options expiration, so that needs to be adjusted. But if you look at the 10-year yield here, the big move on the 10-year yield, closing now above, this is up 0.4%, closing to 4.62%. Remember, we closed at 3.62% the 2 days before the first rate cut. On the day of the first rate cut, that was the first day yields really started to take off, got back above their 8-day. Well, this is actually the day right there, the first rate cut. We got above the 8-day, and we've been higher ever since. Now officially 100 basis points up above the low point before we had the first rate cut. So as has been mentioned by a lot of people online, the Fed has cut, since this time frame where my cursor is, the Fed has cut the overnight rate by 100 basis points, but the 10-year yield has moved up by 100 basis points. As a result, if you look at the yield spread between the two, and I actually tweeted about this yesterday, if you look at the yield spread here between the two, it's really taken off, right? So since right before that first rate cut, so it was about 130, but really by the time we got to 9/16, it was 122 basis points. Has gone up 150 plus basis points to get up above zero, and clearly get up above zero. So I brought up this chart on Twitter, and I posted this on Twitter, this yield curve. So when we have rates, when the rates rise, eventually they fall, right? That's kind of the nature. If I were to go all the way out, then we'll zoom in. When you have an interest rate hike cycle, eventually you have a cut cycle. Hike cycle, cut cycle, hike cycle, cut cycle, hike cycle, hike cycle, cut cycle. It might take some time in between the hike cycle, like we had here, and the cut cycle. And over here, it took quite a bit of time. We had 94. We had a few cuts there, mid-cycle adjustment. And then we just went flat. But the difference here between what we see then in 94 and what we see now is the short-term rates never did exceed the long-term rates. So that's why it kind of went sideways for so long. But all these other times where short-term rates move up to the level of long-term rates, then there's a cut cycle, cut cycle, cut cycle, cut cycle. The only other time really that short-term rates did not exceed long-term rates was here in 2018, 2019. The long-term rates actually fell below the short-term rates, not because of the rate hikes, but because the 10-year yield started to fall. We had that mid-cycle adjustment, and then COVID brought them back to zero. But here's our rate hike cycle again. But short-term rates clearly got above. So if I were to zoom back to now 20-year chart, you can see back here in 07, we had a very similar thing happen. After a rate hike cycle, and they went sideways for a while, we had one last kind of hurrah here where long-term rates jumped up and tried to get back, in fact, did get back above short-term rates by a little bit, as you can see right here. That was in June of 07. And, well, here, let me just bring up my tweet. Let's see here, it's right here. So during that cycle, from March 07 to June of 07, you can see the 10-year yield rallied quite a bit, not quite 100 basis points. Remember, the Fed was not cutting rates here. The Fed didn't start cutting rates until September. But that was what the 10-year yield did. During that same time frame that the 10-year yield went up, the 3-month yield dropped quite a bit. So again, it's as if the Fed was cutting. Remember, the 3-month is the effective Fed funds rate. So it was as if the Fed was cutting rates, but they didn't, right? It dropped about 50 basis points here. The Fed never did cut rates till September, but the market was cutting rates for them, right? This is the overnight rate. The effective Fed funds rate essentially is what the 3-month. It's been dropping here because the Fed has actually been cutting rates since the September timeframe started to drop ahead of those first cuts, and then now it's kind of caught up. But that's what was happening there. 3-month dropping, 10-year yield rising at the same time. So that little spread jumped up. And if I were to look at it from this perspective, if I were to change this chart, and we'll come down here to the bottom, and we'll look at the 3-month instead of the 3-month here instead of the 10-year. Okay, so here's the spread, right? Here's the spread between the 3-month, the 10-year, and the 3-month spread, and you can see it's really gone up quite a bit because the 10-year the 3-month has been dropping. The 10-year has obviously been rising. Here, let's get rid of right there. So there's your 10-year rising up above the 3-month, which is the red line, and that's why we're positive. Again, very similar to what happened between March. Right here, March of 07, all the way up to June of 07. It was negative, it went positive, and that preceded what ultimately was a big jump higher in this because the Fed started cutting rates for good, right? That was the rate cut cycle. So here we are, we've had a rate hike cycle, and we've gone sideways. And I think a lot of people anticipate late 90s type move where we just go sideways for a long time. The issue is, the reason why we went sideways for so long is because we never raised rates so far that exceeded the long-term rates like we did pretty much every other rate hike cycle. And so it might be a very temporary thing like we saw in 07 where we had like one last little hurrah where long-term rates did exceed and the yield spreads went positive and then the rate cut cycle emerged. So that would mean that, again, our best case scenario is that we just somehow just go sideways for all year long, and we just kind of stay around this 4%. The Fed doesn't raise rates, we just stay here. I think that's the best case scenario. Markets are able to stay bullish. Otherwise, if the Fed starts cutting rates like all these other instances, that's generally associated with a need for cutting rates, which the biggest need, and they don't talk about this very much, like on TV or anything, because they don't dive into this. They're very naive when it comes to following the Fed policy. But the biggest reason why the Fed cuts rates is because they try to stimulate demand. And you think, there's plenty of demand. Housing prices are high. They're so high that not that people can even buy them. The housing prices, people are spending money. The consumers are in malls. There's plenty of demand. Well, this measures. This is a really good measure of what demand looks like. Sorry, we'll go from a rate a year ago. This was just updated about a week ago to give us a final estimate of the Q3, and then we'll get updated again kind of mid-January for the first Q4 estimate. And you can see this measures the exchange of money from one hand to another. That same dollar. So I spend $1 on a good. That company that sold me that good spends that same dollar on something else, and then that same dollar goes from one person to another as it exchanges hands through transactions. The more transactions, the stronger the economy. The fewer the transactions, so that dollar stays in my pocket. Maybe I buy it and nobody else uses it, but it just doesn't exchange hands. That's what this is measuring. And so you can see when this line drops precipitously, you can see 1995 right here, and the need for those cuts at the end of 95 and the very beginning of 96 is because the velocity of money is dropping very rapidly. And the supply of money typically offsets that. So you don't get that exchange of goods, so you start just making more money. And you can see the supply of money. This one did just get updated yesterday for November. It's rising rapidly again, up to 3.73%, which is those two go hand, that money stays in my pocket. the Fed create, or they print more money to get more money in circulation because I'm not spending my dollar. If I'm spending my dollar and everybody else is spending it, they don't need to put more money in the system. And so that's why they kind of move hand in hand. And of course, higher money, you get inflation that goes along with this. And so that's the issue. And that's why the Fed is cutting rates. So again, if there's a need for rate cuts to bring this down, then that means that money is not exchanging hands, and that's a recessionary aspect. So that's something to really kind of monitor. Again, our best case scenario is the Fed does not need to cut rates next year, that they can maintain that this velocity of money starts to slow down like it did in 96 and stays bullish here through 96 and 97. A little bit of drop in 98. We had some rate cuts there in 98, and then that helped stem the tide, and we turned back up in 99, but they couldn't stem the tide in 2000. 2001 and so on. Same thing in 2007 when they started cutting rates right here. They couldn't stem that tide, and that's when we get the shaded areas. And that's what I think we're worried about with all the cuts that they've had so far at the end of this year and potentially what might end up happening here next year. So I don't think this is going to 5%. I think it's going to be limited by the Fed funds rate, number one. And number two, as we can see, the higher yields has really put pressure on equities and will continue. The correlation right now between bonds and equities, when you look at SPX down there, is still very positive, especially when you look at it over, not just a 2-week period, but a 3-month correlation between bonds. In fact, someone said, there was a tweet, I think I mentioned it here. Let's go back to my Twitter, because I think I also retweeted that one here, that the correlation right now, no, this is the top 10 holdings. I think I just maybe liked it. The correlation here between, did I not even like it? Here it is. The correlation between bonds and stocks is the highest it's been ever on record, going back to 1997. 1976 is when this particular record started. So again, that's a reflective of a inflationary environment when you have stocks and bonds moving up together in this situation. All right, so which means higher yields putting pressure on bonds. Fortunately, going into the beginning of next year, it looks like yields are peaking. It looks like the dollar, which is also typically not a good sign for the stock market, also appears to be peaking. So we may be going into a new calendar year coming off of some pretty strong trends. When you look at the DMI for the dollar, that ADX is at a pretty decently high level, right? So, and then you look at TNX here. Let's look at TNX. No, this is it. So let's go back to TNX and look at the 10-year yield. So you can see, again, it's not as high as it was, but still pretty high level for the directional indexes. Pretty big gap. So this is going to catch up here. It's a lagging indicator, the black line. So that's probably the most positive thing we have going into 2025. And hopefully, again, that stems the tide for rate cuts. I believe we don't get another rate cut for the rest of the first half of next year. And we go into, we go into June. That's probably when we're going to start looking at our first potential rate cut. And if we go into a cut cycle by the end of the year, that's going to be the danger, right? And I think that's probably why our skew is as high as it is, because everybody sees that the anticipated direction for this after going up and then flat is to then go back down. And when that happens, who knows? But it doesn't go back down. The Fed doesn't cut rates just for fun. They cut rates because they have to. And again, the reason why they would have to is the drop in that velocity of money. The breadth today was horrible. Really, really bad breadth. As you can see, the McClellan oscillator is negative again, back below that minus 35 level. Remember, we've already crossed zero on the summation index. When you look at some of these other indicators that we use to measure breadth, we really want to see a big drop or a big jump in the number of stocks above their 50-day moving average and a big jump in the number of stocks above the 200. But this one, even more so, it's still really at bearish levels. Anything below 200 is bearish. We're clearly below 200. In fact, the average now, in fact, it's kind of rare for the average to be this low to not even really be on that much of a decline. But that, and combine that with this ratio, the number of stocks above the 200-day, if I were to zoom out a little bit for some context on this, because it looks like we're low, but the reality is we're not that low. When you look at it in this perspective, getting below 250 is the kind of sign that we are going into a little bit more of a decline than normal. But again, what really you need to see is this ratio drop below its average, because that's when things turn higher and stay higher. Because that means we have a big number of stocks crossing above their 50-day, and obviously that hasn't happened. And then you look at the number of new highs and new lows. The new highs index is still extremely low. The new lows index is still up at a pretty decently high level, above its average and above that 115 mark, which represents 4%, which represents, again, a lot of negativity, right? A lot of negativity. And you look at this ratio of the Qs to IWM, it also appears to be peaking, and its ratio looks like it's returning back to its normal positive correlation with the S&P 500. So with risk appetite in general. So with yields and the dollar peaking and this ratio peaking, we may get some temporary bullishness in equities led by the Russell. But as we saw back here in July, it's a very temporary phenomenon for this ratio to fall and the markets themselves to rally because of the 493 stocks rather than just the Mag 7, which has done a great job over the last week or so keeping the markets from really suffering more than what maybe they should have. But today you can see kind of a big drop in a lot of these big names, and then Nvidia, of course, failing at its moving average and rolling over. Again, one day doesn't make a change in trend. You still got dark green shading and a green line, but if we lose the leadership here, then we most likely lose the intermediate trend that we've been on. All right, that brings us to our trade idea of the day, and I'm going to take a look at Snowflake. It's in that tech sector, software space. Getting a bull tag today, down more than 3% below the moving average on this drop. It was down 3% today. The intermediate line crossing below market sentiment. You can see the bearish short-term sentiment there. If you look at the weekly chart, you can see we don't have a red arrow yet, but we do have we've shifted from bullishness to bearishness clearly here. If you look at the 3 green arrow chart, we'll just go straight to the 2-line version. You can see how we crossed below the MACD has gone negative. The histogram's been negative for a while, but we've crossed below the moving average. So we've got 3 red arrows now. The stochastics is clearly bearish as we're dipping into the value area and dipping below this kind of big volume node. When you look at some of these other oscillators on the chart, you can see that we were so strongly bullish, but now we have a bearish crossover. The positive is barely above the negative sign down there, and the ADX has dropped like a rock. If you look at the RSI and the CCI, after they were strongly bullish post earnings, now in the lower half of the chart, we've already been below minus 100 on the daily. The CCI is dropping back below 100 after spiking there. You look at the Ichimoku cloud for Snowflake, we are well below the green line, and that's how close we are. We're probably 2 days away from having a negative rate of change. Just like that, you can see the big, strong, mature bullish trend we had is gone, so no trend there. And then finally, when you look at the Bollinger Bands and the Keltner channels, the bandwidth has gotten so big, but now you can see the bands have moved back outside the Keltner channels, but we have negative momentum now. So we've shifted from bullish momentum to negative momentum, so we're flirting with the lower half of the chart. So what I decided to do there is to try to take advantage of this gap right here in volume and the gap down to the 50 and 200-day moving averages by selling for the rest of this January expiration, selling the 149, buying the 152.5. So that gives me this gain. You can see the 149, that puts me right about here. So it's right above the 50 and in between this gap here. It gives me about a 2.5 to 1 reward to risk ratio. So again, a relatively for how low that delta is, low 20s, that's a pretty decent reward to risk ratio. In other words, it's not very strong, which means the probabilities of getting it's pretty high when you're not getting as rewarded for taking such. I mean, that's a big risk, and you're not getting rewarded for taking such a big risk, which means you're more likely to get it than not. You get it not 100% right. That's why we have the position size with this maximum loss. But we have a lot of flexibility if the trade doesn't work out immediately for us. All right, well, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out of the top right corner of your screen. That takes you to our Market Outlook forums. Open up it in your thread there. Reply to anybody else's thread. Let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Follow us and join us on at Twitter and Facebook as well. Have a great rest of your holiday weekend, everybody, and we'll see you all next week.